Welcome to the Deep Dive, your shortcut to what's really moving the needle in travel tech. Today, we are jumping straight into the chaos around the latest Sabre earnings. That's ticker SABR. The call was pre-market November 5th.
And this one is just essential to unpack because, look, this print was a story of massive contrasts. Sabre just sold their hospitality solutions business, which is huge. It completely changes their financial story.
But the stock got hammered.
An absolute train wreck. The operational story and the guidance created a total disconnect. So our mission today is to filter those signals, look at the numbers, and really figure out what drove that sharp sell-off.
Okay, let's just get into the numbers right away, because the headline was, frankly, almost absurd.
Yeah.
If you were just looking at GAAP net income, you'd think this was the best quarter ever.
Right.
Thanks to that one-time gain from the hospitality sale, Sabre reported GAAP net income of around $848 million?
Something like that. It led to a GAAP EPS of about $1.98, a huge positive number.
But that's not the real story.
Not even close. I mean, as any investor knows, you have to immediately look past that one-time event and go straight to the core business health. So we look at adjusted EPS, the number that shows how daily operations are actually doing.
And that's where the trouble started.
Mm-hmm. Adjusted EPS came in at a loss of 1 cent.
A 1 cent loss, which, sounds tiny, but the expectation to Street was looking for a gain.
Exactly, a gain of 4 to 6 cents. So that difference, a negative surprise of 5 to 7 cents per share, that is a material miss.
And that set the tone.
It set a deeply cautious tone. The market basically said, hey, great job on the sale, but your actual business is underperforming what we thought.
But the top line, the revenue, that was actually a little bit better than expected, wasn't it?
It was. Revenue came in around $715 million, so a slight beat, maybe 1% versus consensus. And that showed decent year-over-year growth of 3 to 3.5%.
So a small bit of good news there.
A small bit, yeah. But then came the third critical negative, the one that really shattered confidence in this release.
Free cash flow.
Free cash flow. FCF. For a company like Sabre with all its debt, FCF isn't just a number, it's the lifeblood.
And they missed it. Badly.
Dramatically. It was positive $13 million, but their own guidance was $40 to $50 million. That miss, plus the adjusted EPS loss. That was the 1-2 punch that sent the stock diving.
Okay, so let's dig into the operational side, because despite those misses, there was some real strength in the actual business segments. Distribution revenue, the GDS side of things, hit $575 million, up 4% year over year. That's pretty solid.
It is, and that strength is really volume-driven. Management pointed to higher air and hotel bookings. And, the really interesting part is the momentum. Air distribution bookings grew low single digits for the whole quarter, but they accelerated. September finished up a strong 7% year over year.
That acceleration is a great sign.
It is.
IT solutions revenue, though, was just flat at $140 million.
Flat, yeah. But if we connect this to profitability, this is where the news gets genuinely good. What's fascinating is that even with the cash flow problems and flat IT, management clearly improved internal profitability. A lot.
How much?
Normalized adjusted EBITDA hit $150 million. That's up an impressive 23% from last year.
23%. Wow. That's more than just cutting a few costs. That sounds structural.
Absolutely. The margin expansion is remarkable. Normalized adjusted EBITDA margin improved by 340 to 350 basis points. It's just under 21% now.
So all that talk about cloud migration and IT modernization is actually starting to pay off.
It seems so. It's letting them deleverage their cost base, even with modest revenue growth. Operating income was also way up, $94 million, putting the margin around 13%.
And we can't talk about any of this without circling back to the balance sheet, the debt.
The structural fix we've all been waiting for.
They used the proceeds from that hospitality sale to repay $825 million of debt.
That is a game changer for their risk profile. It's not just a number. They even reiterated their goal to basically cut net leverage in half by the end of 2025. This gives them crucial breathing room. They can focus on tech instead of just servicing debt.
So if we pull that all together, the strategy seems to be twofold. Finish cleaning up the balance sheet, and then drive growth through AI.
Exactly. And they had some genuinely exciting updates on the AI front. They launched something they're calling Agentic APIs for travel. They're positioning this as like the foundational layer for AI-driven booking.
Okay, can you just quickly define Agentic AI? Is this like the system goes beyond just answering questions and actually starts planning and booking on its own?
That's the goal. Precisely. Optimization AI handles pricing. Generative AI does chatbots. Agentic AI is that next level, that innovation horizon. It's about creating a layer that can understand what you want, execute multiple steps, and manage complexity without a human holding its hand. They're doing it in partnership with Google.
And they're also pushing hard on the airline retailing side, moving away from the old models.
Correct. Their SabreMosaic platform is the vehicle for that. They just announced a big new win with Ethiopian Airlines, a major carrier.
And what about NDC, the new distribution capability?
They're up to 41 live integrations now. Now, to be clear, NDC volumes are still tiny, like 2 to 3% of total air bookings.
But growing fast.
But growing very, very rapidly. That's what management is stressing.
One thing I found really compelling was their payments business. It feels like it's flying under the radar a bit.
It's becoming a significant growth story. Quarterly gross spend in payments grew over 40% year over year. It's processing over 20 billion in annual transactions now.
40% is huge.
It's massive. It's made up of Sabre Direct Pay and their virtual card platform, Confirma. They expect to have something like 100,000 hotels connected by the end of the year. It's high growth, high profit revenue.
Okay, this just makes the whole situation feel even stranger. We've got massive debt reduction, accelerating bookings, 40% growth in payments, and yet the stock traded down sharply. It fell 9–10%.
That is the central paradox.
The market just completely ignored all this good structural news and traded the quarter strictly on the forward guidance.
And that's the disconnect we have to talk about. The market has a short memory when the guidance hits are this bad. They cut the full year 2025 revenue guidance. It's now expected to be flat year over year, down from low single-digit growth.
And the free cash flow guidance was the real gut punch.
Oh, absolutely. The pro forma FCF guidance was just slashed. It's now only around $70 million for the full year. It was $100 to $140 million before.
A huge cut.
Huge. When you deleverage the company, the market expects cash flow to go up, not down. Pro forma adjusted EBITDA also landed at the low end of their range, about $530 million.
So why? Why the big miss on FCF in the cut? Management tried to explain it in the Q&A, right? They blamed timing.
They did. They said 1/3 of the Q3 shortfall was lower receipts and 2/3 was higher disbursements.
Okay, let's unpack that. Lower receipts.
They said it's a working capital thing. There's about a 30-day lag between a booking and when they actually get the cash. And since July and August, bookings were flat. That strong 7% growth they saw in September, well, the cash from that won't show up until Q4.
I get the lag, but timing issues often sounds like an excuse for missing the forecast. What about the disbursements? That was 2/3 of the miss.
That's a fair question, and I think the skepticism is warranted. Management said a few large payments got pulled forward into September from Q4 or even next year, like a $7.5 million agency payment.
Which may be true, but it still suggests they don't have a tight grip on their quarterly working capital. It erodes confidence.
It really does.
Yeah.
And on top of that, they cited a macro headwind that's kind of unique to them.
The U.S. government shutdown.
Yeah. I have to admit, seeing government shutdown as a headwind for a global travel company it's a unique detail. It just reminds you how concentrated their exposure is to that specific segment.
And what was the actual impact of that?
It reduced their Q4 air bookings growth guidance by 3 full percentage points, down to 6 to 8% from 10. This is all travel by government employees, U.S. military. It's about 4% of their global air volume.
So despite all this, management is now betting everything on Q4.
Everything. They're projecting significant cash generation. They need to hit about $130 million in pro forma FCF in Q4 alone.
Is that even possible?
Well, Q4 is typically their strongest quarter for cash due to seasonality. But that $130 million target is now the pivot point for the whole story.
And you have to put it in context. The stock has been a massive underperformer.
Materially. A one-year return of negative 55% versus the S&P's positive 17.5%. Investor skepticism is incredibly high, and until they hit that huge Q4 target, it's not going away.
All right, let's pivot to our This Is Not Financial Advice segment, given everything we've talked about.
Yeah.
The debt reduction, the margin improvement, and that huge post-earnings volatility collapse.
Yeah.
What outrageous but plausible trade idea comes out of this mess?
Well, the technical setup is really interesting for a speculative trade. The implied volatility, the IV30, was spiking over 110% going into earnings. Classic pre-event behavior.
And then it got crushed.
Classic post-earnings 5E crush. It dropped right into the mid-70s.
A drop from 110 to the mid-70s is a massive change in how the market is pricing risk.
It is. So the thesis here is that the market is way too focused on the short-term noise of the FCF miss, the 70 million full-year guide, and is completely underestimating the strategic progress on the debt. The pitch, which is speculative, is to either start a long position after this fear-driven sell-off, or maybe sell some volatility, like a straddle or a strangle, expiring in early 2026.
So you're betting that the worst of the fear is over and the remaining premium is too high.
Precisely. The bet is 100% predicated on management hitting that huge $130 million Q4 FCF target. If they hit that number, the credibility gap shrinks overnight. Sentiment stabilizes, and the stock is set up for a significant bounce from these 52-week lows. It would reward anyone who bought after the volatility collapse.
So the whole bet hinges on their ability to execute in Q4 and restore faith. A very clear catalyst.
That is the entire thesis. Hit 130 million in FCF, and the story shifts from uncertainty to structural recovery. And, to just reiterate the core paradox of this whole call, you had a stunning GAAP headline and great operational margin improvement.
Right, from all the structural changes.
But those positives were just completely overshadowed by the adjusted EPS miss and those really material cuts to the full-year cash flow guidance.
So for you, the listener, there are two key things to track going forward. First, can management actually deliver that $130 million Q4 FCF target? That is everything for restoring confidence. And second, how quickly can they monetize all this new AI tech, the Agentic APIs, and those big platform wins like Ethiopian Airlines?
And that second point is where it gets really, really interesting, especially when you consider management's own commentary. They said the overall intermediary GDS industry is probably going to be flat in 2026.
But Sabre is forecasting growth for themselves.
They're forecasting mid-single-digit bookings growth. So that raises the critical question. How much market share do they really need to gain with their new low-cost carrier solution and agency wins to justify that forecast against a flat industry? That's the metric you need to watch. That required share gain is the key to whether they can actually hit their long-term growth goals.
That's the real challenge, finding growth where the market has none. Thanks for diving deep with us on Sabre.
Always a pleasure.